So chapter chapter one, objective 3 is really uh, the heavy lifting in this chapter. Every chapter has an objective that you're going to spend like a ton of time on, and this is the objective in this chapter. You're going to be spending a lot of time on, and that's because they introduce you to the primary financial statements that we use in accounting and in business in general, like I was explaining. And then you're going to be preparing them. You're going to be preparing them. That's a time-consuming task. That's a time-consuming task. So I just wanted to put that out there. Okay. Of the 4 financial statements you're going to be introduced to today, we are going to be focusing in on 3 of the 4, and I will give you an idea of what those are. The first one is one of the most important statements in accounting and business, the income statement. The income statement is the only statement that can answer the big question. Did we make a profit or not? Okay. The income statement is the only statement that can answer that because it shows you for a period of time what the revenues of the business were for that period, usually a month, and compares it to the expenses in that period. And like you learn in objective 2, when you compare revenue and expenses, what you want is more revenue than expenses, because that's what we call a profit, or formally net income. Okay. So the income statement is the only statement that can tell us whether we had a profit or a loss for the period of time. So now that you have a profit, say, this book is happy. The first 4 chapters of this book is a very happy book. All the companies are profitable. Only we wish that's the case in reality, but in the book, like I said, it's a happy book. So let's say the corporation did make a profit. The question is, whose profit is it? Right. Well, the owners own the profit. The owners own the company. The owners own the profit. So the question then becomes, what do the owners want to do with the profits of their company? And most people would say, well, they would want to put the money back into the business to help it grow. Okay. Well, there's a statement that shows what they do with the profit, and that's what a retained earnings statement is. Okay. So the word earnings, by the way, is synonymous with the word profit and income, net income. All right. So you have 3 words that are interchangeable in accounting and finance. We use them the same all the time. So net income means profit. Profit means earnings. Earnings means net income, etc. They're all interchangeable. As a matter of fact, this week, if anyone watches the business news, this week is a very big earnings week on Wall Street, because about 20% of the S&P 500 companies, big ones like Apple, for example, and Microsoft and others, are reporting their earnings. In other words, they're reporting their profits. So earnings is about profits. And like I was telling you, the owners want, as most owners want to do, is they want to retain those profits in the company. They want to keep the profits in the company so they can reinvest those. And again, we go back to investing activities. Reinvesting means purchasing more assets so the company can grow. Okay. So this statement, called the retained earnings statement, shows how much of the profit, that's the earnings word, has been retained in the company. Okay. How much has been kept in? Well, what else can happen to the profit of a company? Well, sometimes companies like to share a portion of the profit with the owners. And that's what a dividend is. And you read about that also in Learning Objective 2. A dividend is simply sharing a portion of the profit with the owners. They just simply basically take the cash out of the company and send it to the owner's personal pockets. Thus, it's not retained. It's not retained. Okay. The third very important financial statement that you're going to be not just learning about, but actually preparing is something called a balance sheet. And the balance sheet, unlike the income statement and the return and earnings statement, which actually show what happened over a period of time, like a month or a quarter or a year, the balance sheet is simply just um, a selfie of the day's financial position of the company. Okay. It shows of a particular day what assets the company has, what liabilities the company has, and what's the stockholders' equity of the company on that day. That's it. That's it. So, like I said, I just get your phones ready, you know, and it's a selfie. Okay. It's basically a financial selfie of the company. And you're going to learn a lot more about that. But these three statements are going to be critically important in this course. Okay. And thus, you have to prepare, you have to know them very, very well. The other statement that is very important, but we don't really emphasize it here, we just introduce it here and we deal with it in more detail in the accounting 204 class, which is managerial, is something called a statement of cash flow. And this particular financial statement shows us basically the flows of cash in and out of the company and for the entire year or for the entire period. And so it's a very specific statement. It just follows cash. Okay, it just follows cash and the cash flow in and out of the company. So this we deal with in, it's introduced, it's an important statement. So it's introduced here, but it's not emphasized until next class, the next course. Mhm. All right, so here's your first look at an income statement. Like I said, the income statement measures a period of time. The periods of time are traditionally a month, a quarter, which is a 3-month period, and a year, which is a 12-month period. We don't measure anything beyond a year, and we don't measure anything shorter than a month. Okay, so so that's important to sort of understand in that regard. Okay, so an income statement in this case is what happened to the company for the month. In this case, we're using Sierra Corporation. Sierra Corporation is the fictitious company in the book that gives guided tours of the Sierra Nevada region, okay, which is out in California. They started their company on October the 1st, and at the end of the first month in operation, they wanted to know whether they made a profit or not. So the income statement for the month ending October 31st tells us that. This, by the way, is considered sort of like a heading of the financial statement. And what income statements have, they only have two major accounts that they talk about. They talk about all the revenue accounts of a company. How did the company earn money by selling what it does? Now, this particular company is simple. They only give tours. So tours is a service, giving a tour is a service. And so they only have one revenue account called service revenue. And here what you see is for the month of October, they earned $10,600 of revenue. So that's quite a lot of tours, you know, in a month's time. Okay. So there's only one revenue account that shows here. However, as you see, this business had a series of expenses. They had lots of different expenses. And what I was mentioning earlier in Learning Objective 2 is now coming true in Objective 3, is that each individual expense needs to be listed separately. We have to identify as specifically as possible what we spent money on, okay, that particular month that created an expense for the business. And so here you have a whole list of expenses. As you see, it's a service business. In a service business, your wages, your salaries and wages, your labor costs are the most, are your biggest expense. Okay, that's true in every service business. It's true for the college, it's true for a hospital, it's true for a law firm, it's true everywhere. Your service, services are work provided for you, work done by people. So you're paying people to do the work. That's your largest expense in a service business. And so salaries and wages expense being the first one, which means that they actually spent $5,200 on salaries and wages in the month of October. Now, this only measures what happened from October the 1st to October 31st. That's it. This is the picture here. They had to pay rent, so there's a rent expense. They used up supplies, and so there's a supplies expense. They had something called a depreciation expense, which we're going to learn a little bit more about over time, which if a company has a long-term asset, like a piece of equipment, like a truck, for example, we talked about companies buying trucks or whatnot. That's an asset, but as you use that truck to deliver more and more stuff, you can expense it slowly through the process of depreciation. And so that's what depreciation is about here. Interest, anytime a business pays interest on a loan, the interest is an expense of doing business, the cost of doing business. So interest expenses are there. And of course, any good business will have insurance because you want to make sure you're covering all those liabilities. When you buy an insurance policy, you're buying it for a period for a year, for example, and you're only using the insurance 1 month at a time. So every month that you use your insurance, that portion of the policy is expensed. Your total expenses are listed in the far right column here. And obviously you have much higher revenue than expenses. And so there you have a profit. Remember, in accounting, profit, net income. Net income is also considered earnings. Again, profit, net income, earnings all mean the same thing. On the income statement, we use net income to show the profits of the company. And here we had a profit in the month of October of $2,860. So the question then becomes, what happens to this particular profit? Now that we know that this company made money in October, what's going to happen to that profit? Well, that's what the retained earnings statement tells us. The retained earnings statement tells us what happened to that particular profit, how much of it was retained and how much of it was paid in dividends. Because those are really the only two things that can happen when a company makes a profit. They're either going to keep it in, most of it or all of it in, or they're going to keep most of it in and pay some of it out in the form of a dividend. They're not going to pay all of it out in a dividend. You're not going to have a company that does that. And there's reasons why that we'll learn about with the corporate structure. So basically speaking, the retained earnings statement tells us the story of this net income. What happened to it? Now that we know we have net income, what's happening to it? Well, a retained earnings statement also measures the exact same period of the income statement because it tells the story of this profit. So it makes sense that the period of time is the same because it's about this summary here, this product. So here what we have is, again, a retained earnings statement tells us that this is a brand new company, so it doesn't have any profits or losses to report prior. So the beginning balance is zero when a company is new. We take and add in the profits of that period of time. So 2,860 gets added in. We subtract out any of that profit that we shared with the owner in the form of a dividend. So it looks like they sent out $500 of that profit to the owner's personal pockets out of the company. So that's why it's subtracted out of retained earnings. So what of this profit, how much is being kept in or retained? 2,360. The difference between the net income and the dividends are being kept in or retained. So again, the word retained is to keep in. The word earnings is profit. So retained earnings, retained profits. Okay. So the next step we have to know is where do we show these retained earnings that the company owners, again, who owns the company owns the profits. So where do we show these retained earnings? Well, they're shown on the balance sheet. The balance sheet is a financial statement that is done for a particular day, unlike the retained earnings and income statement, which is done for a period of time. That's a very, very important piece of information. Okay. Balance sheets show us the assets of the company. Remember those assets, the resources that the company owns, right? On a particular day, and the liabilities and stockholders' equity of that company as of that day. The most important thing to know is it's called a balance sheet because the assets equal the liabilities and stockholders' equity. So the total amount of the assets, the total, is going to equal the total amount of liabilities and stockholders' equity. This is why they call it a balance sheet. It is balanced. Okay. And it makes perfect sense because if you have, remember, let's go back to our talk the other day. If you bought a $10,000 car, you would need to have $10,000 of resources to buy a $10,000 car. And so if you just did it for you personally, your asset would be a $10,000 car. Well, certainly your liabilities and equity need to equal the $10,000 because you needed $10,000 of resources to buy the $10,000 car. So the same thing works here. In order for a company to have over $21,000 of assets, they needed over $21,000 of resources. Okay. So the resources are liabilities, which is borrowing money for others, right? It's the debt of the company. Or the owners are putting the money in. Okay. The equity. So those are the two pieces here. There are a number of different liability accounts, some of which you've already been introduced to, such as a note payable, right? Remember the word note means loan, tend to be short term. Accounts payable, that's a bill that's due within 30 days. Okay. They have a bunch of other payables here as well. One very interesting liability that doesn't use the word payable is a very important liability to know about. This particular account is called unearned service revenue. So what this means is, and it's very simple, the customer has paid the company up front for, in this case, a tour, and the company owes the customer a tour. So because the company owes the customer, that's why it's a liability account. So for Sierra Corporation, which does tours of that region, it looks like they have received money from customers upfront for tours in the future. So thus, we show that in accounting as owing the customer a service. So thus, unearned service revenue is the account. This is a very common account with airlines, with vacations, with sporting teams, anyone that does performing arts. You're usually buying those tickets up front, right, for a future date. Whether it's a vacation, a cruise, for example, or a plane ride, plane flight somewhere, or you're purchasing tickets up front for an upcoming sporting event or a concert, you're giving money up front to that company. The company has to say they owe you something for that, okay? Because they do. They owe you a cruise, or they owe you a plane, a flight somewhere, or they owe you a concert, or they owe you a hockey game, or a basketball game or something. They owe you something. So that's why unearned revenue is a very important liability account to become familiar with, because it's very, very common. It's very, very common. And it's the only liability account that doesn't end with the word payable in its title. Stockholders' equity is all about the owners, right? This is about the owner's equity. You already know the owners have put money in exchange for shares of ownership. Common stock represents their share of ownership. They put $10,000 in for $10,000 of ownership. But as you just seen here, they had a profit. And I asked you the question, well, if a company makes a profit, who owns the profit? The owners. own the profit. So that is also shown here on the balance sheet. Retained earnings is basically a list of the profits that the owners own, right? From all the time of the company being profitable. So retained earnings basically shows that these are profits of the company that have been retained, but they're owned by the owners, thus their stockholders equity account. Okay. So you have a lot of different things here. The assets, again, the resources, they do tend to be listed in the order of liquidity. You'll learn more about that in chapter 2. But cash certainly is an asset. And when we say cash, we really mean all of the company's cash. Most companies keep their cash in a bank. They have their own bank accounts. They might have some cash on hand, but basically speaking, it's the main banking accounts and the amount of cash the company has. We talked about accounts receivable the other day in objective 2. Again, accounts receivable happens is because you've already done something for a customer and you're waiting to receive payment on the account. So an accounts receivable is an asset because you're waiting to receive the cash. So once they give you the cash, it'll be cash. Supplies are assets. This particular company does tours, so apparently they need a certain amount of supplies to help them do that job well. And so when they purchase the supplies, they're an asset. When they use those supplies, then you get a supplies expense. Insurance, when you buy insurance, like I said, you're buying insurance for a period of time, usually a year, right? So when you buy insurance, it's actually your asset because you have purchased a whole, say a full 12 months of coverage. However, after every month, you've used up a portion of the coverage. Once you've used up the coverage, then you can expense the portion that you've used. But otherwise, prepaid insurance simply means it's an insurance policy that's your asset because you bought it up front for a period of time. It's good for 12 months. It's not good for one day. You can't expense it when you buy it because it's not good for one day. Okay. It's good for 12 months. So you have to wait to use it to expense it. And equipment is a long-term asset that's used by many, many companies. I don't know what type of equipment these folks use here, but obviously they're going to be using it for a number of years. And so it's listed last. Okay. So these are the 3 major financial statements that we focus on in this course. And these are the 3 statements that you need to know how to prepare. The best thing to do, by the way, is to have copies of these statements in front of you when you're being asked to prepare them. You don't have to do anything from memory in this course. What you need to do is find the resources that you need to get the job done. So if it's telling you to prepare a balance sheet, you need to have a sample of a balance sheet in front of you so you can do a balance sheet. Because I don't want you to do it from the top of your head. That's not how we do it. That's just not how it's done. We usually do it from a form that's already been somewhat completed, right? So that's what I want you to do. I want you to use these as resources. So if you don't have your book, by the way, this particular section is a good section to print on Wiley because you will need these illustrations in front of you to do your homework. I think they're very, very helpful. As I mentioned, the assets equal liabilities and stockholders' equity. That's what makes the balance sheet balance. This is also called the accounting equation. It's called the balance sheet equation, but the accounting equation is basically what it's really known for in almost all the books in accounting there. This is something that you have to know, and it's very, very important. Again, to remember, balance sheets are selfies of financial snapshots of the day, whereas the income statement, retained earnings statement measure a period of time. The minimum period of time they'll measure is a month. The maximum will be a year. The other statement that they introduced to you here that we're not going to be really getting into in any detail until next course, is the cash flow statement. And again, the cash flow statement focuses on cash coming in and out of the company throughout the period. So here, the period of time for the cash flow statement is the month. They have a certain amount of cash coming in from operating activities. They have used a certain amount of cash to buy equipment, and they have raised money from financing activities. And so they had no cash at the beginning. They raised $15,200 of cash through all of this process through the year. That's why they have $15,200 in cash, and that's what you see on the balance sheet. That's how these statements are connected. Again, you don't have to prepare this until we get much, much later into your studies. Okay. All right, so your book has do-it exercises for you on the financial statements. I will be putting up a significant amount of homework very soon. Right after the class is done, I was starting to do a little bit of it this morning and got distracted, but I will get everything up for you within the hour after class. Everything will be up and ready to go. But you'll be preparing financial statements. Again, very, very important to understand. A lot of what you're going to be asked to do is to prepare. And because you're going to be asked to prepare, it's time consuming. It's just time consuming. It just takes time to do this. Okay. So that's why I mentioned early on, it's a time consuming course. It just is. It just takes time. And again, you do them in order. The income statement is always the one you do first, always. Then the retained earnings statement is done second. And then the balance sheet is done third. Okay. Now, in this case, this particular company is brand new. They just opened up on January the 1st of this year. And what they're asking us to do is to prepare the statements at the end of its first year of operations. That's why there's no retained earnings, is because you have to do an income statement to find out what they are, right? You have to find out what the profits are. You know that there's dividends here. So the question mark will be answered after you prepare the retained earnings statement. The question mark will be answered there. So that's what all this stuff means. So first, it's important to identify accounts. If the first thing we're going to be doing is preparing an income statement, the question is what goes on an income statement? And only two types of accounts go on an income statement: revenue and expense accounts. And so your service revenue is your revenue account that's going to go first. And then you have some expense accounts. You have supplies expense, you have a rent expense here, and it looks like here you have an insurance expense. So those accounts are the only accounts that are going to be used to prepare the income statement. Okay. That'll give you a net income or a profit. Like I said, all these companies are very happy. They're very, very profitable. Thus, you use that profit along with the dividends account to prepare the income, the retained earnings statement. Then after that, your balance sheet. You have to identify the asset accounts. Accounts receivable is an asset, equipment is an asset, supplies is an asset, cash is an asset. If you identify the asset accounts to put your assets together, then you identify your liability accounts, like accounts payable, like notes payable. And then you put together your stockholders equity accounts, which is common stock first, retained earnings with the answer from the statement second. And what it all looks like is this, and this is all in your book. If you actually have your book with you, the do-it exercises are very good resource as well. This is on page 17 in your book. So if you have your book, page 17, if not, it's simply part of learning objective 3, kind of towards down at the bottom of the page. So again, revenues and expenses, but again, the specific revenue is listed, the specific expenses are listed for a total. You might notice here, this book likes to put expenses, big numbers to small numbers. That's perfectly okay. But if you did the small to big, I wouldn't mark you wrong, because at least you've identified all 3 of the expenses properly. And if you notice here, your revenue is much bigger than your expenses, and so you'll have a profit, which of course we call net income on the income statement. And again, the period of time of this income statement is the year for this company. Retained earnings statements show that this is a brand new company, so they don't have a previous statement to show a profit or a loss, so the balance is 0. They're going to add that net income that you just calculated and to subtract out the dividends. The dividends were listed in that long list of accounts, giving you, so that they made $6,800 of profit. $600 of that was sent out of the company in the form of a dividend. So what are they retaining? The profits that they're retaining, $6,200. Remember, retained earnings, retained profit. And the balance sheet, again, your assets have a very specific order to them. This is why you need to look at the other balance sheets in the book, so you know what the order is, and you'll get used to it. And there's more detail in this order in chapter 2 that's coming up. Liabilities are, and of course the total assets are listed first. Your liabilities are listed and totaled. Your stockholders' equities are listed and totaled, and then these numbers are added together, because those 2 numbers are going to balance out to the assets. So this is what's really important to understand, is that this looks relatively simple. It just takes time to do. I mean, I don't think it's very, very difficult. It is time consuming. And this particular chapter ends with just a little bit of something called an annual report. Annual reports are required if a corporation is publicly traded. In other words, they have stock on the stock market of any sort. They are required by law to submit regular reporting of its financial statements. And the biggest one is called an annual report. Okay. They have to do quarterly reports as well, but the annual report usually is quite large. Okay. So the annual report basically shows all those financial statements that you just learned about on there, including explanations of, these 2 should really go together, explanations on what some of those accounts mean and what it signifies. The biggest part of the annual report is management discussion and analysis of what's going on in the business. Okay, that can be a very, very big part of it. And then, of course, because they are preparing financial statements and because this is a public company, they're required to be audited by an independent accounting firm to see whether those financial statements are following the rules that have been agreed to. Those rules are called GAAP, Generally Accepted Accounting Principles. You'll learn a bit more about those in chapter 2. Okay. So this is just, again, elements of the financial report, an annual report. Management has to discuss, this is the biggest part, they do have to discuss things that are favorable and unfavorable and any events that might affect some of these types of things. And this is actually, this is a very bad example, because this is only a paragraph in something that can be anywhere from 25 to 100 pages long, depending on the annual report. The notes sort of clarify financial statements, and there'll be lots and lots of notes to those financial statements. The auditor has to be a CPA. Certified public accountants are experts in financial accounting. And so they know how the income statement is supposed to be put together. They know how the balance sheet is supposed to be put together. They are looking to make sure the companies are following those rules, and they are verifying that this is fairly represented. Okay. And they are following the rules because they are in compliance or conformance with generally accepted accounting principles, GAAP, GAAP. Okay. So this is basically what this is about. You don't have to worry. This is a very minor part of the of this chapter, and it's something that we will talk about a little bit, not a lot. But it's definitely something that is important to sort of understand in general. Um, but those financial statements, that's critical. That's critical. So I'll stop this lecture for here and ask if there's any questions.